The dollar doesn't collapse with a bang, it disappears in confidence. Quietly, gradually, then all at once. One morning, your bank balance still says the same number, your salary still hits your account, the stock market still opens at 9:30, but something feels different. Prices move faster than explanations. Interest rates spike unexpectedly, foreign governments stop buying US debt, and suddenly the question is this temporary? How did we not see this coming? Because when the world's reserve currency dies, it doesn't warn you, it shifts, and by the time most people notice, the game has already changed. So what would actually have to happen for the dollar to fail? And more importantly, would you recognize it before everyone else panics? For over 80 years, the US dollar has been the center of the global financial system. Oil is priced in dollars, global trade clears in dollars, central banks hoard dollars. After World War II, the Bretton Woods system locked the dollar to gold. When that ended in 1971, the dollar became backed by something else. Not gold, confidence in the US economy, confidence in US military power. Confidence in US debt being the safest asset on earth, and for decades that confidence held. But here's the uncomfortable truth, reserve currencies don't last forever. Before the dollar, it was the British pound, before that the Dutch guilder, before that the Spanish silver was real, each one dominated global trade until they didn't. Do you see the pattern? Dominance creates leverage, leverage creates debt, debt creates fragility, and fragility hides inside strength. A reserve currency gives a country enormous power. The United States can borrow in its own currency. It can run deficits for decades. It can print money in crises without immediate collapse. In 2008, during the financial crisis, the Federal Reserve expanded its balance sheet aggressively. Quantitative easing, trillions created electronically, markets panicked then stabilized. Why? Because in times of crisis, investors run to dollars, not away. That reinforced the belief the dollar is untouchable. But something changed after 2008. The scale, debt levels exploded. US national debt moved from under $10 trillion to over $30 trillion in just over a decade. At the same time, interest rates were artificially suppressed. Cheap money became normal, risk became invisible. Tell me if this sounds familiar. Easy money, asset bubbles, rising inequality, faith in permanent stability. We've seen this before. Here's the part most people misunderstand. The dollar doesn't collapse because America is weak. It collapses because incentives shift. Countries like China and Russia have slowly reduced their dollar reserves. They explore trade agreements in alternative currencies. Why? Not because the dollar is worthless, but because dependence is vulnerability. If global trade diversifies away from dollars, demand slowly declines. And if demand declines while supply increases, the math becomes uncomfortable. More dollars chasing fewer external buyers. Add rising interest payments on national debt. Add political gridlock, add repeated debt ceiling standoffs. Confidence doesn't vanish overnight. It erodes. One decision at a time. Wait, does that mean hyperinflation? Not necessarily. That's the dramatic version. The more realistic version is slower, higher borrowing costs. Persistent inflation, weaker purchasing power, volatile markets. A gradual shift where the dollar loses privilege, not existence. And here, where psychology enters, most people believe reserve status is permanent. It feels permanent because it's all we've known, but history says otherwise. Would you have believed in 1910 that the British pound would lose its dominance? Probably not, yet it did, because empires accumulate debt faster than they accumulate discipline. Every system has a breaking point, not a dramatic explosion, a moment when confidence hesitates. It could be triggered by a sovereign debt crisis, a geopolitical shock, a major treasury auction that fails to attract buyers, a rapid spike in interest rates that the government can't afford. When investors demand higher yields to hold US debt, interest payments rise. Higher interest payments mean more borrowing means more supply means more pressure. That's the loop, and loops accelerate. In 2008, the world trusted the dollar during the crisis. But what happens if the crisis originates from the dollar itself? That's an uncomfortable scenario. Do you see the difference? When trust weakens in the asset meant to be the safe haven, the shock is structural, and structural shocks don't resolve quickly. They reset systems. But here's the part no one talks about. The dollar doesn't need to die to change your life. It only needs to weaken. If foreign demand drops, domestic inflation pressure increases. If borrowing costs rise, taxes or spending cuts follow. If inflation persists, real wages stagnate, your savings buy less. Your rent rises faster than your income, your investments swing more violently, and most people won't connect the dots. They'll blame corporations or politicians or greed. But underneath it all is confidence. Confidence in the currency, confidence in the debt, confidence in the future, and confidence is fragile. So what does this mean for you? It means stability is conditional. It means diversification isn't optional. It means understanding incentives matters more than predicting headlines. Because when systems shift, the early observers adjust quietly. The late believers panic publicly. Would you recognize early signals? A sharp decline in foreign treasury holdings, a sustained weakening of the dollar index, uncontrolled fiscal expansion without growth to support it, or would it just feel like another news cycle? Be honest, most collapses don't look like collapses while they're forming. They look like policy debates. They look like temporary inflation. They look manageable until they are. But let's stay grounded. Is the dollar about to vanish tomorrow? No. Reserve currencies decline over decades, not days. The risk isn't sudden extinction. It's gradual erosion, a slow transition toward a multipolar currency system. The euro, the yuan, digital currencies, commodity-backed trade agreements, not replacing the dollar overnight, just reducing its monopoly. And when monopoly fades, so does privilege. The ability to print without consequence, the ability to borrow without restraint, the ability to assume it will always work. Here's the deeper pattern. Financial systems collapse when confidence outruns reality, when debt grows faster than productivity, when politics overrides discipline, when short-term comfort beats long-term stability. The dollar's strength has always been tied to trust. If trust weakens, everything shrinks. Assets, wages, debt, risk, the shift won't be announced, it will be felt. In volatility, in higher living costs, in geopolitical tension. And most people will say, no one could have predicted this. But history says otherwise. Do you see the pattern now? The day the dollar dies won't be marked by headlines declaring the end. It will be marked by a slow realization that the rules have changed, that borrowing is harder, that stability is thinner, that confidence is conditional, and those who understand structural fragility don't panic. They prepare not out of fear, out of awareness. Because systems don't collapse randomly, they follow incentives, they follow debt, they follow human psychology. If you understand that, you're already ahead of most people. Most people only see the collapse after it happens. The few who recognize patterns early move differently, and this is the kind of pattern most people won't notice until it's too late.